Mihir Vora, Director and Chief Investment Officer, Max Life Insurance, is with us. Mihir, thanks for coming back on. You just started responding. We lost the line. Go ahead. You're talking about the market, Mihir. How's it looking? You were saying it's in a consolidation phase.
Yes, after the knock that we took in the last couple of months in the local and the global markets, we did believe that we were in an oversold territory at that point in time when the markets were, Nifty was trading at about 6,800, etc. because the fall was just too sharp and quite indiscriminate in certain cases in terms of valuations. So a couple of things have happened. Locally, we've had a decent budget where probably the fiscal aim is to stay on the path of prudence. We got a good CPI number last night, which means that there is a good chance that we might see the easing cycle continue. And globally, the fact that commodities have stabilized and the Chinese yuan is now moving in both directions, not only in the direction of weakening, has led to some amount of normalcy as far as risk appetite is concerned. So we have seen FIIs in India coming back to buy, not in a massive way, but in the last few days at least that I can see, last 7 to 10 days, we are seeing consistent net inflows in the cash segment, and we are seeing some short covering also in the F&O segment. So yeah, after the big knock that we took in Jan and Feb, we are coming back to limping back to normalcy, I would say, and now it's back to stock picking and sectors allocations.
On earnings, how are we looking, you think, Mihir?
So in earnings, after the third quarter numbers, estimates have been downgraded, especially because of the sharper than expected write-offs that the PSU banks took. So FY16 earnings now are low single digit or almost zero, and FY17 earnings we have not downgraded that much. So we still expect about 15+% earnings on a year-on-year basis.
For 17, is it?
For FY17, that's right.
Okay. Mihir, I was just talking about Crompton with my colleague earlier. I mean, I'm sure you've looked at the stock over the years. It's now split into two. How should one look at these kind of situations?
So Prashant, as you know, I can't comment on specific stocks. But ultimately, when you are looking at a demerger of any kind, you do have to get into the SFTP valuations. So that's all I can say.
Okay, fair enough. That's cryptic, Mihir, but I guess you can't do better, at least in terms of specifics. So what's your focus really, Mihir, in terms of sectors or sectoral bets really?
So you know that we have been positive on the private sector financials, banks as well as NBFCs, construction companies, railways, those kind of themes. And broadly speaking, even after the budget, we are very convinced that these are the bets still to be in. The only mild tweak that we would have done in the last month or so is in the metals space, where we believed that prices had gone down to levels where maybe 30-40% of global capacities in many metals would become unremunerative and there would be production shutdowns. So we are seeing initial signs of production reduction in many countries like China and Russia in some of the metals. So this is a space that we are now looking at in terms of a space offering us very cheap valuations. Though it won't be a structural call, it probably might be a medium-term call because valuations have become quite cheap in some of the cases.
In any one particular commodity, or I mean across the board?
Prashant, the massacre has been across the board, not only commodities but even oil, as we know. And at these levels, whether you talk about copper, aluminium, zinc, oil, a lot of global capacity, if the prices were to sustain at the levels that we saw in February, would go out of production, become unsustainable. So obviously the markets have had a self-correcting mechanism. Though we still might see some bankruptcies, we still might see a lot of stress at the corporate level globally. But as long as we stick to the most efficient producers, some of them which are present in India, they might be worth a look at these levels.
So that's the only thing which you've changed in that sense, right?
Absolutely. And of course, the basic view remains the same, a slow recovery, a path to slow growth recovery in India, aided by fiscal policies, and as long as global risk conditions remain normal, unlike the ones that we saw in Jan-Feb, FIIs should continue to put money into Indian equities and fixed income. So while we have seen beginning of equities inflows from FIIs, in the fixed income market there are still minor outflows. But my guess is that as things stabilize, even fixed income should start seeing money into the country.
Right. Public sector, public sector banks. You said you're bullish on private sector financials. Would that also include some of the beaten down corporate, heavy corporate exposure banks as well, which have come off quite a bit? I mean, without naming names, really.
Yes, that would include that. Absolutely, yes.
And that would be a recent addition, or you continue to hold on to them for a while?
We've held on to them in Jan and Feb. We didn't sell because even in December we thought valuations were quite cheap. So we took a bit of a knock in Jan and Feb, but we held on and added a bit, so we're fine right now.
Oil marketing, Mihir?
Oil marketing we continue to like, though not as much as what we did last year, because valuations have risen, so to say. But we are still holding on to the positions because the PEs are quite cheap, though we may not see massive earnings growth, but they are still cheap, not as cheap as they were 6 months back. So we would say we are now more holding on to the positions rather than being very extremely bullish.
Holding on to positions. Fair enough. I don't know if you did mention pharma, IT type of sectors. If you did, I apologize, but I didn't hear you talking about those.
Yeah. So in pharma we continue to be underweight. Because we need to take money out from some sector to be overweight on the other sectors. So that's one thing, and there is still a lot of uncertainty regarding the FDA's approach. And even good companies are receiving notices and inspection reports, etc. So that's a sector which is frankly very difficult to track and understand. So we have an exposure, but we are significantly underweight. In IT, we have actually reduced the underweight positions a little bit because we do see that the US growth, while there were big concerns, it may not be so bad. So corporate America is doing okay. And we do see that at some point in time, when the markets were volatile, IT was a good hiding place to be in. So we reduced the underweight a little bit in the last couple of months.
Mihir, thanks very much for your time. Good chatting with you. It's a pleasure.